I think just to come back for a second and summarize some of the main impacts that we're going to have there, it gives the ability for lower monthly cost, right? Because we're
Yep.
stretching that out, your monthly payments are a little bit lower. And if your monthly payments are a little bit lower, that helps you borrow a little bit more because it's all about looking at the
Exactly.
GDS and TDS there. And then if you can
Yep.
borrow more, you can be able to get into that market a little bit easier. And I
100%.
think the other thing that you highlighted, because we'll get to the negatives in a second, but I think the other thing that you highlighted is the way our mortgage system here works in Canada is because we typically just take these on 5-year terms or sometimes lower, it can be a short-term solution. So you may be looking at this and be like, why would I ever do this? I'm going to spend more money over the time. I'm going to spend more in interest now over the term of my mortgage and over the length of my mortgage if I keep doing this. And so there's elements of that where, yeah, it doesn't make financial sense, but it can be a short-term solution for somebody
Exactly.
that just needs that for that first 3 years, and then we'll be back on track. Nicole, thank you so much for joining us this morning to talk about the announcement in regards to insured mortgages and changing amortizations. It's something that, a lot, really everybody's talking about right now. So it's important for us as realtors to have that information so that we can educate people. And so I'm curious from you today, first, of course, what was the announcement? And then how do you think this is going to impact people? Who will it help more? Who will it not really be for? If we can maybe get into that discussion as we go,
For
that'd be
sure.
perfect. But start us off.
Okay, so as you kind of mentioned already, lots of big news this week, just in general. So a few months ago, I can't remember exactly what it was. I want to say it was like April-ish, but we had an announcement, and you guys probably remember me saying it was a bit of a teaser, and in all honesty, it was kind of a whole lot of nothing back then, because we had the announcement that for insured mortgages, so insured mortgages meaning a down payment of less than 20% when you're living in the home. And with that, we had, because currently we can only do a 25-year amortization, a standard amortization, 25 years. And so a few months back, we had this announcement that we were now going to be able to have the 30-year amortization for insured mortgages. But then there was this little disclaimer and teaser that, oh, by the way, it's only for new builds. And that's kind of where I was saying to you guys, like, not really going to do much, like, thanks, but no thanks kind of thing, right? Like, we'll take it, but it's not really a big thing. So one of the biggest things is that now, and when I say now, it's coming into effect at some point in December, and we'll talk about that in a second. But now the 30-year amortization is across the board. So it doesn't matter if it's a new build, if you are purchasing a home and you're going to live in it and it's an insured mortgage and less than 20%, you can have a 30-year amortization. So what does that really mean? Why is that helpful? Ultimately, it will help to do two things. It will help stretch your affordability, so your purchasing power, because ultimately what we're doing is we're taking the loan amount and the money that you owe, and we're stretching that over another 5 years. Now, people will say to me all the time, but why is that a good thing? We're just getting more debt for a longer time kind of thing. And one of the nice things with Canadian financing, it's, different than our, US counterparts, for example, is that even if we have a 25 or a 30-year lifespan of the mortgage, we typically will renegotiate or renew our terms on average every 5 years. Nowadays, it's been even shorter than that, 3 years, for example. But nonetheless, you can renegotiate the term. So let's just say, for example, we now can take a 30-year amortization and help you qualify, help you get into the market. So a lot of these first-time home buyers, right? And then we can renegotiate in 5 years. And if we want to catch up and we can afford to take that amortization down to 20 years, for example, and do things like that, we can do all of that. So ultimately, 30-year amortization, very favorable. It's also going to make the monthly payments lower, because again, you're stretching that amount of debt out another 5 years. So it will help from the affordability standpoint on both the qualification of purchasing power, but your monthly costs. And let's be real, like everybody right now, even those, in current, mortgages and already in homes, we're looking to be able to, kind of keep that comfort and that cash flow every month, right? So that's a big one. Part of this announcement is also the fact that that insured mortgage and insurable mortgage sort of product was capped at $1 million for up until like this announcement. Now, it may not make a huge difference for your market centers in terms of where you are, but like if you're looking at Toronto, Vaughan, Oakville, like any of these, it's very, very common that a first-time home buyer or your first home can be over $1 million, right? It doesn't have to be 1.5, but maybe it's slightly over. Maybe they're listing it at 999 and you need that extra 20, 30, $40,000. And now all of a sudden we can't because it was capped at $1 million. So now that cap is $1.5 million. So meaning, if you wanted to purchase a house, your clients had to purchase, at again, we'll just say it right over that $1 million mark, they can technically get an insured mortgage up until 1.5. So ultimately what that looks like is, let's just use the max cap. Let's just say 1.5. Previously the $1.5 million home, that minimum down payment, I should have wrote this down before. What is that? 300,000. There you go. I'm like doing math in my head. 300,000, right? Because it would have been 20%. Whereas now, you could technically have a minimum down payment of 125,000. So it's a big difference. And again, I don't think that we're going to have, a ton of clients running out there and buying a $1.5 million property. But again, just being able to have that little bit of wiggle room over that $1 million mark, I definitely think this is going to be a big thing to potentially get some of your clients into the market. And again, that 30-year amortization. So a couple really big things though with this. First of all, we don't know the logistics. And in all honesty, it's super frustrating on our side because the same way that you guys were finding out is the same way that I find out. Reading the articles, reading it would be really nice if we got a heads up saying, hey, anybody in the finance industry, the lenders, the brokers, anybody, we knew this. Even CMHC themselves, the insurer, finds out the same way. Like we see this, government announcement. And so the honest answer is we still don't know the logistics of it. And what I mean by that is we know that it's pretty much gonna likely to come into effect mid-December-ish. It's right now we're looking at any time over after December 14th. So I'm using a date of December 15th. What's unclear is that I don't know if this, officially passes. We're unsure yet if you send me a deal tomorrow with a closing date of December 30th. We're unsure if you can qualify for these rules now because it closes after December 15th when the rules are in place, or if because the rule doesn't come into place yet and it doesn't come until mid-December, you have to qualify as the rules are currently right now, right? Which would mean if the latter is correct, what would mean, well, you would need to have a closing date sometime early next year because we can't submit these new purchases until December 15th essentially to qualify under the new rules. So that's what we're kind of waiting on. In previous history, because this is not the first time the government has done these kind of things, we probably won't hear for a few weeks. So the honest answer is when you guys are calling me and asking me, I don't know the logistics yet. So it's tough. We know it's coming. The other thing is that the lenders still have to follow suit. They still have to agree to all of these rules,
Yeah, to
basically.
offer those products.
Exactly. And so you'll hear about the talks with the federal government and CMHC. CMHC is one of 3 insurers. So we've seen it before where things come into play or are introduced or proposed. And the other 2 insurers are like, thanks, but no thanks. A little too risky for us. We don't like it. And it's quite possible that happens. And then in with the insurers, you also have the lenders. I expect that all of the big banks are going to follow suit and we're not going to have an issue there. But the monoline lenders, right? So the non-big bank lenders, again, you guys know I work with like 60 plus lenders. Majority of all of those are these monoline lenders and non-big banks. So it's quite possible because a lot of these lenders are investor based and things like that a lot of them might say yeah, we don't really like this. We feel it's a little too risky, or we feel it's a little. I don't expect that's going to be the case, but we've seen that and it is quite possible. So this is important again because when we hear about these rules and we think these things are in place, or we're aware that they're there, I can anticipate that until we know that everybody is on board, clients are going to be like, well, this is the new rule. And they think that every single option is available to them. So maybe this lender has a great, lower rate, for example, but maybe they're not in line with, some of these new products and new proposed rules and stuff, right? So it is going to be a little messy for a little while, I think. And but all in all, I think it's really good news. And I think it's something that we've kind of been waiting for. So we'll kind of see. Before I kind of keep chatting, do you guys have any questions on that? Oh, I
Yeah, please, if
expected
you guys have
less.
any questions, raise your hand, put them in the chat. We'll make sure we get to you. I think just to come back for a second and summarize some of the main impacts that we're going to have there. It gives the ability for lower monthly cost, right? Because we're
Yep,
stretching that out, your monthly payments are a little bit lower. And if your monthly payments are a little bit lower, that helps you borrow a little bit more because it's all about looking at the
exactly.
GDS and TDS there. And then if you can
Yep,
borrow more, you can be able to get into that market a little bit easier. And I
100%.
think the other thing that you highlighted, because we'll get to the negatives in a second, but I think the other thing that you highlighted is the way our mortgage system here works in Canada is because we typically just take these on 5-year terms or sometimes lower, it can be a short-term solution. So you may be looking at this and be like, why would I ever do this? I'm going to spend more money over the time. I'm going to spend more in interest now over the term of my mortgage and over the length of my mortgage if I keep doing this. And so there's elements of that where, yeah, it doesn't make financial sense, but it can be a short-term solution for somebody
Exactly.
that just needs that for that first 3 years, and then we'll be back on track for whatever the reason. It has to be
Yep,
specific,
yep,
but nonetheless, it lets them do that. I think
exactly.
the downsides obviously could cost you more over the term. I think it could also push people to borrowing more than maybe they should be borrowing because now we're talking about a new way to max out their budget. And I love
Yes,
the example that you use. Hey, it doesn't mean you have to go up to 1.5. Maybe just is just that threshold of like, I was at a million before, that was my cap. At a million 20 or a million 30, I get the job done, but that 30 grand wasn't letting
exactly.
me apply, right? So I think that'll help some of those people there. And then the other thing, a concern I think I would have is for the people that are doing it over the 5-year term, when they then go to renew or they go to sell, they're likely not going to have as much equity in the home as they would the other way. So now, realtors, when we're looking at how we're helping people and they need that equity to make the step up or even just to cover closing costs, well, there might be less equity there in a 5-year term than what we would have seen otherwise because they're paying more interest.
Yes, 100%. And that's a really good point as well. And I think that's like in the conversations that you guys are having with your clients, and if you're reaching out to your database, for example, I don't think the message is, great, now we can go and purchase 500,000
Yeah.
more than we could before, right? Like it's just, I think it really needs to be, hey guys, we have a little bit of wiggle room. If you were close to that, like price point, or that, I'm sorry, that cap, well, you know what, maybe we can, because like I've had so many clients come to me and so many realtors come to me and say, hey Nicole, like we just need, like, if you're in that, like, even that 950-ish spot, right, like maybe you just need a little bit more to to kind of get you above that threshold and stuff, right? So I think that's really what it comes down to. So it's just about talking, that you have more wiggle room, so to speak.
Yeah. And I
Yeah.
think the other questions that us as the market and mortgage brokers, as the professionals, that we don't have indicators yet from the lenders and as it passes through CMHC and all that
Mhm.
is when is this eligible? Like you said, we're playing with that kind of December 15th date, but does that mean I can close a place on December 17th? Or can I submit it as of December 15th? And as long as it closes in like January, 10th, and we've got enough time to submit with the new rules? Or is it going to be a lot like how Tressa was, same kind of change for us, where it's like 3 weeks later, a month later, people still don't know how this thing is working. So maybe it doesn't actually
Exactly.
become eligible until January or February, depending on what that looks like.
Exactly. And that's, and it's a little bit, it's harder on our side as well too, because if I look back at all the historical sort of rule changes, because we've had some big announcements over the years,
Yep.
typically it's been okay, hey, a trickle effect, and it's lender specific in terms of how they're implementing it, right? So sometimes we can, certain lenders are adopting it now, and as long as the closing is after, and sometimes it's like, no, we're only doing it from a qualification. So that's where it's even more hard, right? Because it's, we're just waiting to see. So again, I don't expect that the powers that be and all of them are going to get it together for the next few weeks, probably, because that's just kind of how it typically happens. Like even if you were to call CMHC right now, like they wouldn't be able to tell you. Like they found out the exact same way that we're all doing it, right? So I think
There's
it's just,
There's
sit
elements of this
tight.
where it feels like a political movement to be like, hey, if we announce this, it'll be cool. And then like all the people that are required to actually pull it off are like, what are we doing? Who told us what?
Yes.
Like it
And
doesn't
that
feel like
is
it was a
literally what it
strategy.
is.
You
Yeah.
know what I mean?
It's frustrating. I was like back-to-back meetings on the I think it was Tuesday or whatever day it came out, and it was funny because before I even got a chance to read through my updates, I was getting calls saying, "Hey Nicole," and I was like, "I'm so sorry. Like, give me 10 minutes to go check through everything that I need to check because it was coming. Again, we were finding out
Same
the
like
exact
that.
same way that you guys were. So, um, there's a couple other things that I just wanted to mention as well too
Sure.
from this week, unless there's any other questions on that. But
I would just
um,
say real quick, Nicole, the other two things that I wrote down that maybe we don't know the answers to yet, obviously was when was it eligible? Does it apply to investors? I've been seeing that conversation going around because I think the language in the announcement was all buyers, but are you
yes.
saying already that we know that it will not apply to investors?
Well, exactly. And that's because it is all buyers, but it is all buyers that are eligible for an insured mortgage. And
Gotcha.
by default, insured mortgage is if the property is owner occupied. So I get that question actually. I'm glad you brought that up. Thank you. I get the question a lot of times where people are like, "Oh, okay, like there's a confusion that as a first, like you can only put down less than 20% or an insured mortgage
Yeah.
if you're a first-time home buyer." And that's not accurate. It's actually as long as the property is owner occupied.
Mm,
So even if you were to, let's just say, for example, you purchased in the height of COVID, you're selling and buying now, but you have to have another insured mortgage this time around because you just didn't have enough equity in the property or whatever the case was. You can still purchase for the second time as an insured mortgage. You're no longer a first-time home buyer, but you can put down less than 20% because you're living in the property. So where I'm going with this is that as an investment property, even if it's the first property you purchase, so as a first-time home buyer, you just decide, you know what, the first property I want to buy is an investment, you technically will lose that incentive in terms of the rebates because you're not occupying the unit, and automatically it's 20%. So it won't matter. So the reason why it's saying all buyers is because it's all buyers that qualify for insured. And if
gotcha.
it's an investment property, 20% across the board. Doesn't matter if you're purchasing at 600,000, it's 20% because it's an investment.
Gotcha. My other question was, what about when it comes to the lending guidelines of not being able to borrow more than X times your annual income? Right?
Okay.
Like you're saying they still have this new package that we're coming out with the stretch dam and up to the
Yep.
1.5, it applies, but you still have to qualify based on all the other guidelines that are in place, right?
Exactly. So nothing changes. I mean, and that's where the 30-year amortization will help a little bit as well, right? Because ultimately how we qualify is we look at household income, debts, credit, and down payment and all those kinds of things. And then we have to fit you in a box. With the insured mortgages, it literally is a box. So you guys know I can, work magic when it comes to stretching ratios and stuff like that. We can't do that on an insured mortgage because again, we have to stick you in that box, right? And the lender's not the boss, it's the insurers. So the way it will help is again with that 30-year amortization, because that payment now becomes lower, ultimately the ratios will become lower. It's easier to qualify. But the rules themselves in terms of how we have to qualify doesn't change at all. It's just more helpful because of the 30-year. But you won't automatically qualify for 1.1. You have to actually physically be able to debt service it.
Yeah. Perfect. Makes sense. I think there was a couple other things that you wanted to mention there, but is everybody following so far? Anybody have any questions about what this might mean?
See people taking notes.
Yeah, I have a question. Hi, Nicole.
Oh, hi, Frank.
Just I want to know, like, if you could explain to me, because like every time they bring the CMHC, I talk to investors about land development, and they have this like uh, MLS program, but I want to know like what the CMHC exactly authority, what do they do, and how is that they are connected to like the mortgage in general, like if you could
So
explain.
Why don't you give me a shout actually? Because that's a separate CMHC kind of thing, and that's a little bit more on the commercial and the land dev side. So
Okay.
we can I'll definitely answer that, and we can talk on that. It's unrelated to this part because CMHC is an insurer, and so but they have different programs. They have commercial programs, land development programs, all those kinds of things, and they're just insured programs for that. But it is different than this aspect, so we can chat more on that. But to answer your question as it relates to this, like CMHC is again one of the three insurers, and so what happens with these programs is that depending on again the loan amounts and purchase price, you will have or your clients will have an insurance premium, a default insurance premium that is rolled into their mortgage. So that's not going to change currently. As it stands right now, and will continue, is that the insurers' premiums, whether it's CMHC or the other two insurers, are a sliding scale. So depending on how much you're putting down, it will either be from 4% to 2.8%. So to give you some perspective, at the 1.5 purchase price with the minimum down payment, your insurance premium, your CMHC and premium is like $55,000. It's a lot of money. So, but those premiums get rolled into the mortgage, and then your mortgage is, whatever the principal amount was plus the insurance premium, and it gets rolled into that. And then again, that's not just CMHC; it's any of the insurers. So
And is it applicable to residential and commercial, or this is only residential when we talk about CMHC?
So again, like there's a separate program for the commercial, and
Okay.
yes, it will be applicable. But for this purpose, we're just chatting about the residential ones.
Okay.
Yeah, but call me and we'll talk on that.
Sure. Thanks,
Nicole,
Nicole.
do you ever get nervous with like I guess what I kind of get my back up against when this kind of came out and they're like, yeah, like you get extra time, 5 more extra years. I just get nervous about the debt. Like I'm just like, do people understand what they're doing? And like even that, like rolling all this stuff into the mortgage, it's just like, yeah, we'll just like throw it down the road. We'll just pay forever. Like who cares, right?
Forever.
Like yeah, I'm just
And
so curious to like see like are people even aware of the amount of interest that they're paying? And like I don't know, it just blows my mind. And like they're so desperate to get home ownership that they're just willing to pay debt forever, right?
so I actually really appreciate you bringing this up because that is very in line with how I do my business and the conversations that I have with clients. And I will be honest to say, there are a lot of realtors and a lot of clients that don't appreciate the actual advice around can I physically do this for you, purchase at 1.5? Yes, maybe. Do I want to, in good conscience, do that for you? No, because you are not going to be able to afford it, and you're probably going to lose your house in 2 years. And you may have even heard me speak about saying no to clients and for lack of a better way of saying it, firing clients or realtors over the years, especially during COVID, for that exact reason, right? And that's kind of why I mentioned even just now to
Mhm.
say, hey, the message, I am not giving you guys a message of saying like blast your database and say you can, purchase 1.5, right? Because it's so important for them to truly understand what that's going to look like. And you even heard me say like, sometimes there's, products that we can use to help them pay down their mortgage more or lower the interest and all that kind of stuff, right? So it's really important, and clients are not going to know. So that's where the mortgage broker or potentially even the realtor, if they have that knowledge, is important to speak to clients, like, because yeah, like
Mhm.
let's just get you in the home for what makes sense for you now, what you can truly afford, not what you can necessarily qualify for. And then let's talk about how, maybe we can upgrade you in a few years, but keep you within your means, and look to see how we can actually take advantage of paying down your mortgage and all that kind of stuff.
Mhm.
Because that's why I say, like, all the time, you guys hear me say, not all products are created equal, and the lowest rate doesn't mean it's the best rate. Because again, to your point, Mike, if we don't have favorable prepayment terms or things that we can do to pay down the interest and pay down the mortgage, well, then a lower rate is not going to help you ultimately, because again, it's this
Mhm.
revolving debt that we're not going to be doing anything about, right? So it really is a happy medium of trying to help your clients attain your goals, but as a professional say, okay, hey, no, we do need to think about it. And it's like, it's the same conversation I've had with renewals, for example, where people are like, why in the world would you take their current amortization and stretch it out to 30 years? That's working backwards, like, because we're trying to pay down the debt. Of course it is. But the immediate goal is, how do we keep people in the house, for example? And then what I was saying earlier is we figure out a plan to, catch up and get back in a few years, right? So all situations are different, but we definitely need to be tackling, how we can also prepay and help them
Yeah.
minimize interest
Yeah,
and debt.
I always get so nervous about that because it's just like they come out and they're like, "Oh, it's just so great for buyers," but I'm like, "But is it? Like, is it really? Like, do buyers really know what this means for them?" And like,
Yeah.
yeah, they can afford it now, but like, they've also just signed up for 5 more years of debt, right?
Yeah.
Like,
And that's why I think
it's
it's,
just
again, it's
so
very
fascinating.
important. Yeah,
Yeah,
I stand true to, it's a really good option to have right now. But again, it
yeah,
doesn't mean that we don't stretch out
it's the
your
best
budget.
option. Yeah,
Maybe, yeah, maybe it means that we, again, we can get you the extra 20, 30, 40,000 that we need to get you in a house that ultimately isn't going to make a massive deal. And maybe we
yeah,
use the 30 years to help you qualify, with the full intention of, in a couple years, we're going to catch up and maybe again take you down to 22 years or 20 years to do that. So ultimately the goal is still the same, to pay it down. But yes,
yeah.
it's the communication around. That's why I said, like, and I had somebody literally called me on Tuesday and said, I'm going to blast this to my database. And I'm like, please don't do that, because the message is not that we can, hey, purchase. Like, no, it's there's maybe a little bit of relief or a little bit of support to help you, because you've been struggling for the last little while, and maybe there's some tools to help you, right? So my
Mhm.
messaging to client is, let's revisit what we did. Do we have any wiggle room here? Is it beneficial to you? Maybe not, right? But
Thanks.
it's definitely good news, I think, but if used correctly.
Yeah, I like that. I like the way you said if used correctly, because that's exactly it. And I think that's a good lesson for all of us is like, it depends on the business you want to run. And I think, Nicole, I think this is the way you kind of operate your business, which is so fantastic, is like, I believe in the same way where I'm like, I'm trying to educate my clients on like, this is a lot of debt that you're taking on. Make sure you have a plan in place, all this kind of stuff, making they understand the financial side of it, that it's not just a payment, right? Because if I told you like, Dylan, you owe me $1,000 a month, and in 100 years you won't owe me that. Well, then what's the point of that?
Yeah,
You'll be dead by the time it's all, you know what I mean? Like it all doesn't matter, right? So it's like I want to make sure that over the course of a time, my payment will be gone. The asset that I have bought will be worth something as opposed to all the interest that I just paid on it.
Yep.
So I try to educate that way. And I think that builds a lot of trust with clients. And I think that's a great way for you guys to build relationships with your clients. And when messages like this come out, exactly that, you can tie in with Nicole. You can bring her in and say, like, this is my trusted mortgage broker that runs a similar business to how I operate. That's here as your resource. And I think that's a great tool to have.
yeah,
Yeah,
for
well
sure.
said,
Thank
Mike.
you.
I think that makes total sense. One of the little thing that I shared there in the chat just now is a breakdown that somebody had sent me in regards to what would change in terms of your monthly payment and your borrowing power in terms of your annual incomes if you stretch from a 25-year to a 30-year.
Mhm.
Example they used wasn't even going up over the new $1 million mark. It was just at the 900K. And so the main difference was if you're purchasing at 900K with a $100,000 down payment, you can see that the CMHC insurance there is the 24,800, which would get rolled in. Property tax, all that's the same. The big difference is ultimately that you're going to save about $408 a month. And this one was kind of funny to me because, again, you hear the news about, oh, it's going to help people borrow better or they're going to be able to afford more. Well, the difference in household income required was $10,000. Like, I don't like at that in this example,
Mhm.
I'm sure in some examples it'll help a little bit more, but in this example, the difference was only $10,000 in terms of household income. So it's not really moving the needle. I think, Nicole, like we talked about before, what it will do, it will help the people that were stuck at that threshold of the million to $1,040,000. I think that's the small group of this
Yeah.
that probably going to benefit from it the most. And same thing, those people that can use this as a short-term solution because
Exactly.
their life situation may be changing where they're going to have more income in the following year. They're just paying off some other debt. And then, like you said, they can take advantage of prepayment options to make up the difference so that we don't have that
Exactly.
equity challenge that we talked about at the
Yep.
beginning of the phone call.
And you'd be surprised by utilizing a lot of those prepayment, like just the strategies and stuff, some of the things I've talked to you guys about before, we can catch up and then some by doing a 30 years, or almost every plan that I put together for our clients, even if it's on a 30-year, I will give them a plan to make sure that within the term, they're at the 25-year or beyond by doing these things. Whether or not they do them, I can't control, but there's always a plan to at least catch up, right? So yeah, for sure.
Yeah.
Everyone
I
get
know
those
we're
I
like,
love that. And I think a big part of this
chat while
too is the
Nicole's still going.
sorry?
I'm just telling everybody, get your daily intentions down into the chat there. Make sure you are intentional about the real estate conversations that you're going to have today. Where are you having them? Is it with your database? Are you hitting the doors? Are you hitting the phones? What does that look like for you? And put that down in the chat so we can help keep you accountable. Sorry, Nicole, you can keep going there. Just want to make
No,
sure
that's just good. I
30,
looked at the
everybody gets that
time.
stuff going.
I know, and I was worried. I knew there was going to be a lot of stuff for me to talk about today. So, anybody else who has more questions on that, as always, please call me. But the two quick things I wanted to mention as well too that we also heard this week is we saw a decrease in inflation as well. Again, all trending and moving in the right direction, sitting at about 2% right now. So that's again good indication that we are going to continue to see discounts coming from the Bank of Canada, but also to our friends in the U.S. We saw. With the Federal Reserve, we saw a 50-point cut there. So there is a very good likelihood that on October 23rd, the next Bank of Canada announcement, that we may see a bigger cut at potentially 50 basis points. Not guaranteed, but it's quite probable. So again, just kind of all moving in the right direction. So with some of these new rules coming into effect and, potentially more options on the variable rate side, again, all sort of trending in the right direction. So
perfect.
Yeah, it'll be interesting to see what they do. I'm kind of curious because it's like with them hitting the inflation number, it's almost like if we keep going, if we keep lowering the amount, it's almost like we're gonna have that deflation, right? Or I don't know. I don't know. It'll be interesting to see what happens.
And we've talked about this already before, Mike, where it's kind of like there's, definitely, of course, not a direct correlation, but, we do, oftentimes tend to follow suit, right? So it'll be interesting to see. I mean, we're going to definitely see those decreases happen, whether they're staggered or not. It'll just be interesting to see if they do, a more aggressive decrease, in October. And if we do, I would suspect that we probably hold tight and sit tight for December. There's no announcement in November. So maybe maybe they do kind of one and done for the rest of the year. We'll see, but yeah, it'll be interesting. So again, it's one of those things where lots of information for you. I can't promise exactly what's going to happen, but at least just give you sort of what we can anticipate so that you guys are kind of aware when you're having conversations with your clients, because I would suspect a lot of your clients are kind of buzzing to want to hear some of this stuff. So I just wanted to make sure I gave it to you so you're prepared for those chats.